Hello and welcome. You are watching Last Tick here on News9 Live. I'm Krishna Kumar and joining me in the studio is my friend and colleague Suyash Maheshwari. And we are at the end of the first week of trading in the brand new financial year, and Indian markets have managed to close in the green. But of course, we have a long road ahead in a brand new financial year. How will that pan out? We will be discussing all that and more with a very special guest. But first up, a quick check of how the markets operated in the first week of trading in financial year 25. Suyash, talk to us. Tell us, how has it been?
I mean, Krishna, FY25 has begun on a rather choppy note for the Indian markets. And don't get me wrong, the markets were able to scale record highs. In fact, Nifty mid-cap and Sensex as well all made lifetime highs in the week gone by. But the problem in my mind has been sustenance. Nifty, I mean, for time and again, we have formed multiple tops around that 22,500 levels. And that is where we are still stuck. I mean, for an up move, a trending up move, Nifty now needs to decisively break above the 22,500 zone, because that in the past couple of weeks has emerged as a key resistance for the index. And if the index once again fails to move past that 22,500, 530 odd levels, I'm looking at two supports. First, it would be 22,400 level. That, by the way, the markets have been able to close above 22,400 in all of last week. And then, if we do break below 22,400, 22,300, which is the weekly low for Nifty, will emerge as a crucial support. And even if you look at Nifty, not many sectors are participating in that up move apart from Bank Nifty. And let's talk about Bank Nifty for a moment, because that has been a main driver for the markets in the week gone by. Bank Nifty has managed to close, at a 3-month high in this week, and it has closed above 48,500 after mid-January, and that has been leading from the front. We know it has a very high weightage on the Nifty index, and the large cohort of private banks, they are also participating on the upside. So Nifty, which perhaps was lacking a leadership role, I think Nifty Bank could take the markets higher from here on. And also, let's look at the broader markets, because the recovery, Krishna, over there has been rather tremendous. Both indices are on a 3-week winning run, but this week specifically, the mid-cap index made a new record high, 50,000 it claimed for the very first time, and surged by about 4% in the first week of FY25. The small cap index, 7% rise on a week-on-week basis. I mean, that's tremendous. The index is once again within a touching distance of its record high as well. But overall, we need to understand that, it was an event-heavy week. There were multiple triggers for the market to react to. On the domestic front, we had a lot of, macroeconomic data that came out. The PMI numbers, manufacturing and services, the auto sales numbers also came out. Then we also had the big event, the RBI policy meet. On the global front, again, a slew of data releases over there as well. And, the commentary that is coming from Fed, it has been rather all over the place. We'll discuss that in just a bit. But rather a choppy start to the market, but again, we need to understand it was an event-heavy week.
An event-heavy week that ended in the green at the end of the week. We have a very special guest joining us on this special edition of Last Tick. We have Mr. Andrew Holland, CEO of Aventus Capital. Andrew, always a joy, a pleasure and a privilege to be chatting with you. I was speaking to you at a very momentous point of time. We're just at the beginning of a brand new financial year, and we have the RBI, the Reserve Bank of India, coming straight forward right at the beginning of the first week of financial year 2025, holding interest rates, keeping interest rates unchanged at 6.5%, focusing on inflation, bringing inflation in India down from the 4.5% to 4% level, which is the target level, whereas markets in India and all across the world, especially on Wall Street, the talk is always about interest rate cuts. Will there be one? Won't there be one? How many? What will be the quantum of rate cuts? Talk to us. How do you view the point of time in which we are operating in right now?
Well, it's still very in terms of when interest rates are going to move, it's becoming more and more difficult to kind of gauge what the Federal Reserve and the each members are saying. If you take yesterday, for example, at one end you had one of the members saying that maybe we're not going to see any cuts the whole of this year, and on the other side you had someone saying, well, we're getting more confident on the data. So, if that's going to be the case, then cuts can come as early as June. So, that's the kind of spread in terms of the views and the narrative coming from the Fed. So that leaves the market slightly confused. We've got some jobs data today in the US. Maybe that will help. But the thing that I noticed about the Federal Reserve is that if you listen to Jerome Powell, the chairman, he's actually, in terms of when he talks about inflation now, we know the target's 2%. He's now saying 2% in time, which means that he's less worried if it's a little bit higher in the short term. And maybe, with election year in the US, maybe there's pressure to reduce interest rates, whatever the case might be. So, that's something to bear in mind as well. As regards the RBI, I mean, there's nothing new in terms of the commentary. I think we all expected that. On a lighter note, if you bear with me, he did talk about the elephant going into the forest. Perhaps the elephant could find Goldilocks and find out if inflation's too hot, too cold, or just about right, because that's what we're all guessing about at the moment.
And, interesting point that Andrew made over there, because, I mean, it's high time that FOMC should rename themselves and call them Federal Open Mouth Committee, because the commentary has been all over the place, Krishna. Mr. Powell came out, a couple of weeks back. He was sounding rather dovish. He said that, we are expecting 3 rate cuts down the road. Then Christopher Waller and Loretta Mester, who are, 2 other voting members, they came out in support of a higher for longer narrative. And now we were hearing, another voting member from the Federal Reserve came out that there could be perhaps no rate cut at all this year. I mean, there is so much flip-flop as far as what the Federal Reserve is really saying.
Right, there is so much flip-flops, but Andrew, talk to us. How do you see the Indian markets operating in an environment like this? You have an RBI which is setting the agenda very clear. I don't think it's, it is concerned with what the US Fed is going to do. It is mostly concerned with domestic factors like India's own inflation. How do you expect the markets to trade from here on?
So I think we've got the results season coming up now, and I suppose there's 2 sectors which we need to focus in on, which the market will focus in on. One is the IT sector, and the other is the banking sector. Now, for the IT sector, I think the commentary is going to be the worst is still not behind us, and the commentary is going to be that it's still lackluster looking forward. So therefore, the play for the IT sector is really on interest rates. So if you're a person who thinks June is when the US Federal Reserve will reduce rates, that will be good for the tech sector, and that will be the tailwind for our IT sector. So I think you're going to take a call on interest rates. So whether it's in the next quarter or a little bit longer, you've got time if you don't think interest rates are going to be reduced so quickly. On the banking sector, which has been a serial underperformer, I think what we have here is the possibility that the worst could be over in terms of NIMs and the pressure on NIMs. And maybe the banking sector is starting to tell you that already ahead of the results. And if that's the case, that could be the catalyst. And I listened to your commentary before in terms of putting the index above that 22,500 for quite significantly, and help the kind of, I'm not saying it's a pre-market rally, a pre-election rally, but help that kind of market move towards the election in June.
All right, and Andrew, before we circle back to the Q4 results of India Inc., I just want to have another question as far as monetary easing is concerned. Do you think RBI will keep the interest rates elevated or higher for longer, until and it waits for the Federal Reserve to perhaps go for that first rate cut? And I ask this because the differential between the the 10-year bond yields or the bond yields in general in India and in the US, I mean, that has contracted, right? Pre-COVID, it used to be somewhere around 4 to 5%. Now it's just about 3%. And with the impending inclusion in the JP Morgan and the Bloomberg bond indices, do you think that RBI is also trying to keep the bond market happy to maintain that differential vis-a-vis US?
I think I think that could be the case as well. My thinking around it is that you're right, with the bond inclusion, you're going to get more fund flows coming into India, into the bond markets. That's for sure. Now, if I'm the Reserve Bank of India, then I would think, I don't need to rush. I'm not going to get any kudos for being the first to reduce interest rates. And I don't want my currency necessarily to kind of depreciate. I want a kind of a steady currency. It's been one of the most steadiest currencies in all emerging markets and developed markets to some extent over the past year or so. So I think having that stability ahead of the bond inclusion is probably what he's looking at. And then when you get those flows coming in, you have the opportunity to reduce rates, whether the Fed's gone or not, without worrying about the rupee depreciating so quickly. So that's probably where the thinking is at the moment.
Okay. We've discussed enough about interest rates. We were talking about earnings. Let's talk about earnings. Let's talk about the triggers for the markets, sectors you expect to do well in the upcoming earnings season, Andrew.
I think the banking sector is the key really for sentiment because it's such a large weightage within the Nifty. So that would be one catalyst for the markets. And I think around the edges, the other kind of sectors, whether it's kind of autos or metals, they should show some good earnings growth, bit of margin pressure for some of the companies, and that's where you'll make your money is picking those right companies within the sectors. I still think going forward that the themes that we've talked about many times in terms of defence spending, energy spending, railways, and infrastructure, and not going to go away from us. And that means that multiplier effect across many different industries will continue throughout most of this year into next. And that's where you probably see the earnings upgrades towards the second half of the year. So overall, I know we started in April, but if I took this year as a whole, then I think earnings growth will be around 15%. And I think the market will probably do the same in terms of returns for the year as well.
All right, and to add to what Andrew was saying, I mean, we are seeing a turnaround in the banking space. It looks like the worst is over. The Q4 business updates of HDFC Bank came out, and the numbers were rather good. I mean, deposit growth, Krishna, that has been the pain point for the banking sector at large because we are in a high interest rate environment. But the deposit growth for HDFC Bank, it was 26% on a year-on-year basis, 7.5% on a quarter-on-quarter basis. That indicates that perhaps there is a bit of a turnaround in the banking sector. But Andrew, coming back to you, I mean, there is one particular sector that I wanted to pick your brains on, and that is the FMCG pack. Dabur also came out with its business updates, and across the board it expects sluggish volume growth. And Dabur is one company, I mean, if you look at it, it operates across multiple FMCG segments, whether it's healthcare, home care, personal care, or food products. So it's rather a proxy for the FMCG pack at large. But now they are expecting, volume growth to be low because rural demand is again not really picking up. So in light of all this, do you expect, FMCG companies to have another difficult quarter?
Yeah, I do. And I think obviously with oil prices and rising as well, that's going to have an impact on other parts of their businesses as well. So where we've been really concentrating our minds is within that consumption spending is where the premiumization is really happening, and beverages has been one of those sectors which we've spent a lot of time and invested in, and that's paid off very well because you're seeing it all the time, right? In terms of premiumization, I'm sure where you are, you probably pop down for a more expensive coffee than you used to have a few years back. So I see this as a very long runway given the young population in India and the kind of move towards kind of trying different flavors, whether it's alcohol or non-alcoholic, and paying up for doing so. So premiumization is where we've really focused our minds, and that's really where it's been paying off quite well in terms of those sectors, with subsectors within consumption spending.
All right, Andrew, stay with us. We are taking a very short breather over here. We'll be back with lots more. Don't go anywhere.
India's ever-evolving urban landscape is witnessing a new revolution. and this one comes on four wheels.
The affluence has been growing. Cars are becoming more a reflection of what you are.
Nobody's talking about hatchbacks. Now what next? The next is the SUV.
The contribution of SUVs is close to 55-60% of the automobile sales these days.
Is that even manufacturers like to sell SUVs?
So, how did a nation obsessed with fuel economy come to love heavy gas-guzzling sports utility vehicles? Let's look at how India fell in love with the SUV.
You are watching Lost Take. I am Krishna Kumar. Now, we continue discussing with our very special guest, Andrew Holland, CEO of Avendus Capital, who continues to be with us. Andrew, the question that needs to be asked over here, you mentioned about it, that is about crude oil. Oil, to put the cliche again out, oil has been on the boil because of all the Middle East tensions. It's hitting levels that it saw in October 2023, in fact, breaching those levels as well. How do you see oil going from here and that impacting equity markets across the world, including India?
Well, I think maybe, gold has been telling us, or the gold price has been telling us that there's kind of a discomfort regarding inflation, and also, some of the tensions which have been picking up in the Middle East. We'll have to see how, Israel and Iran, what implications they have, for the recent kind of problems, because that's really what's going to move the oil price, and whether that's temporary and whether, something, moves quicker in terms of the world kind of coming, to Israel and trying to get a ceasefire, and so forth and so on. So, it could be a spike up. But then that would force, I think, a lot of countries to kind of try and bring Israel to the table a little bit quicker than maybe they're doing so at the moment. So you have to keep an eye on it. If you notice the share prices of some of the kind of sensitive companies, like say the paint companies, they haven't really reacted. So I would say that at this point, the market's saying, it's still going to be okay. It's just spike because of the tensions rather than there's going to be more action.
All right, and to add to what Andrew was saying, oil certainly, by the way, has been on the boil, but the markets are giving it a cold shoulder right now. I mean, Krishna, $91 a barrel. We have not seen this level, as you pointed out, since October 2023. So a 5-month high on oil, and we are, approaching uncomfortable territory if we are not already there. But remember, oil, I mean, we are net importers of oil, so that definitely, lends to inflationary pressures as well. And even Mr. Das, in his speech, this morning said that the oil component has helped, the decline in oil prices has helped inflation, keep inflation in check, especially the headline number. And it's back on the rise. It's, surging once again. In 2024 alone, in the first 3 months, oil prices are picked up by about 20%. And not just, on a macroeconomic level, but a lot of industries, they are dependent on oil because it's a key raw material for them. Paints come to mind, rubber comes to mind, chemicals come to mind, even pharma for that matter. So a continuous surge in oil prices will definitely squeeze out the profit margins for them. So it's a double whammy for us if you look at it, because it will add to the inflationary pressures and at the same time it will squeeze out the profit margins of India Inc.
Right, and of course that will also make it difficult for us to keep that inflation figure in check as well. Okay, we will let oil be, but at the end of the day, the year 2024 is all about elections, Andrew. It's an election year in India. We're gearing up for it in full flow. Election fever is on in India. It is an election year in the US. In an election year with so many movable parts and components for the world equity markets and India, what kind of an outlook do you have? And I'm asking from the point of view of a retail investor who's trying to stack up his portfolio right at the beginning of the financial year. How is somebody supposed to approach a year like this?
Yeah, it's a great question, and I think we're all kind of looking at that. So let me put it in two parts. I think after the state elections, we had a very strong rally here in India, and I think we've seen the confidence the incumbent party, kind of coming back to power, and therefore policies remaining largely unchanged. And I'm going to come back to that in a second. On the US, it's obviously more difficult. If you take a history of the US elections, you usually have a pre-market rally ahead of that. And from the people I've been speaking to in the US in terms of fund managers, the narrative is this. Less on Biden because it's we can see what's happening there already. But with Trump, the equity markets like him. He's very equity market friendly. Where they do have big concerns is the kind of policies he could bring in, which would be unexpected. Whether that's from NATO to Russia, Ukraine to the Middle East. You're not quite sure what he will do, and that's what worries the market. So equity-wise, love him, but policy-wise, a little bit more cautious. So that's the first part of it. So I suppose the takeaway here is you're going to get pre-election rallies, both here and in the US. Okay. And secondly, after the election here, this is a key point. What's going to happen in the budget? And whether there's going to be any change in taxation, particularly for capital gains tax.
Okay, you're actually speaking as if it's a foregone conclusion that Trump is going to be back as the next president of the US. But Andrew, we have like 30 seconds left. Give us your one quick hot take on those looking to enter the markets this year. What should be their mantra?
I think their mantra has been fantastic, right? It's been done through SIP. So just continue doing what you've been doing. I mean, they've actually performed very well. Okay.
So systematically invest in the markets is the word coming in from Andrew Holland, CEO of Avendus Capital. Andrew, always a joy chatting with you. Hope to keep having you here on the channel again and again. But for now, we'll let you go. We've completely run out of time. Thank you so much for speaking to us. And with that, it's a wrap here from our side. Thank you so much for watching.
Forty countries, 1,000 multilingual bookstalls, 1.25 lakh people, one destination, the New Delhi World Book Fair 2024.
So it's a great honour to be here. Thank you to the National Book Trust and those that have embraced us over recent days.
I was at the London Book Fair once and I had not participated here, but this fair is an ocean and it's beautiful.
This should be your annual spring picnic.
Through the power of knowledge, we are going to create responsible citizens, global citizens with global skills and also global responsibility.
This and more